All right, welcome to chapter 2 of the day trading course, and today we're going to go over risk management. So, if we pick up where we left off in the last lesson, what separates good traders from bad traders? Ultimately, it's risk management. Your ability to manage risk is the most fundamental. It's the most fundamental concept of day trading that you need to understand. Managing risk is number one. So that's why we're talking about it so early in these classes, because even more important than picking the right stocks and choosing the right patterns is going to be your ability to manage risk. Okay, this is what's going to separate you from the winners from the losers. If you're able to manage risk, you have a much better chance of becoming a successful trader. Okay? So we talked about this a little bit in the last lesson, but using proper risk management principles, we can actually be right less than half the time and still make money. So when we get that kind of profit loss ratio where we can make money and only be right half the time, it actually takes a lot of pressure off us to pick the right stock every single time we take a trade. Right? Because we know we're using a profit loss ratio where you know you can be wrong a lot and still make money. We're putting the statistics in our favour. We're putting the odds in our favour to be a successful trader, and as we know, the statistics for being a successful trader are not very good. We want to do everything we can to boost those numbers, right? A lot of new traders make it, well, they don't make it past the first year. And I think the biggest reason is because, well, quite frankly, they're not managing risk properly. But learning the curve for trading is a steep one. So, okay, if you're taking losses during your first year, back to back to back to back, you're simply not going to survive in the market long enough to learn. So one of the things you want to understand is that right now we're focusing on teaching you survival skills in the market so you can survive for your first 6 months without blowing up your account. Anything I can do to help avoid seeing any of you have a day where you lose $4,000 or $5,000, I mean, I'm going to do it, right? Because those days have happened to me too. Many times, I've had a period of probably 6 months where I had a winning streak where I made money, and then I would have a bad day, and on my bad days I would lose a huge chunk of change. So it would be like 10 little steps forward and one huge step back, and then 10 more little steps forward and another big step back. I kept trading on that pattern for quite a while until I was able to control myself and be disciplined enough not to have those major blowout days. So going on here to the next slide. To be successful in trading is not about being right 100% of the time. It's about learning to cut your losses when you're wrong. I only get into setups, I only take setups that I think are going to go for me. But inevitably I'm going to be wrong some of the time. And I'm going to see something that I'm going to think this is a bullish setup, and it's going to break out here. And sometimes I won't be right. My percentage is actually a little over 70%, and that's really good for me. And I'm very proud of that statistic. It still means I'm wrong a lot. So part of learning to be a good day trader is learning to be wrong and have it not be a big deal. So imagine if all your losses were only $10 and your winners were $90, right? You don't need to be right that often to cover those losses. In fact, if you're right just using 10% of the time, you'd actually break even. So you don't have to be right 100% of the time to be a good profitable trader. A good profit loss ratio, even 10 to 1, means that you can be profitable as a trader. So focusing on risk management, even more than choosing the right stocks, is incredibly important. So I'm helping you gain the tools to survive in the market while you continue to learn better strategies and how to get really good setups and getting to the point where you can achieve 60, 70, 75% success. Something that takes months, if not years for many people. It definitely took me a long time, so I don't expect any of you to get that kind of success straight away. But I want to set you up so you can make money even if you're right only half the time. So choosing stocks, the right stocks on one hand versus managing risk, I want everyone trading stocks, but since you can make money with a really bad percentage of success, as long as you're managing risk, you know it's okay if you're still not really good at identifying what is a strong stock or what's a strong pattern. And more important, that every single trade you take has good profit loss ratio. That's what you're risking. Okay? So you want to be looking for a 2-to-1 profit loss ratio. We'll apply the fundamentals of risk management to proper stock selection, and we'll chat and chart patterns when we go over those in future classes. But for right now, just understand that the most important thing is managing your risk. So when I was a new trader, this is probably going to sound familiar to you actually, I would take trades and I would have no stop. I would just buy 5,000 shares, 10,000 shares, and I really didn't know where I was going to stop out. Okay, this was very risky, but I had $30,000 account and $120,000 of buying power. Really, I guess I had more money than I actually had knowledge, and that itself is a really risky thing for me, and why I lost so much money in that first 5, 6, 7 months. For instance, I will buy a stock at, let's say, $9.90, thinking I'm going to sell this up at $10 and get a nice little bounce, if you will, and it will go up to $9.94, and then it will pause there. And then all of a sudden it would drop to $9.80, $9.70, and I'm thinking that, well, maybe I'll just hold this and I'll stop at, let's say, $9.50, right? If it breaks $9.50, then I'm really just going to have to bail out, okay? And it breaks $9.50, and then I get slippage, and I get filled at $9.40, and I lose 50 cents. Okay, I just took a 50 cents loss on the share. And did it have the potential to make $1? No, I didn't. So just think about the risk-reward ratio. This is $1 averaging out, right? Sell half when you're up and a little bit, and then sell a quarter when you're up a little bit more. So to get an average profit of $1, I mean, that's a really huge winner. There's no way that stock was going to go to, say, $10.90. So what I should have done is, recognizing that my target was only 10 cents in profit, I should have had a 5-cent stop. So using a proper stop of 5 cents, that's 10 of 50 cents, right? So I could have been risking 10 of what I actually risked if I was just using a good profit loss ratio, but I didn't understand at the time. I just thought, well, it still looks good, and I don't want to blow out of this. But in reality, I could have just said, I could say, take 1,000 shares and move on, right? Take a loss, move on. It's easy to recover from 50-cent losses. It's harder to recover from $500 losses. $1,000 losses, $5,000 losses, right? When you start taking big size and then adjusting your risk parameter mid-trade to accommodate the loss, holding on to losing positions, you can really get yourself into a bad situation. And that's what I would say usually happened to me when I first started trading. I would get into this at $9.90 and maybe take 5,000 shares. I would be in way too heavy, and I would think, oh, it's going to break, it's going to break $10, and I'm going to sell it at $10.05, 10 whatever, and I'll make $700 or whatever, $1,500, something like that. But then when it just pauses there at $9.88, $9.93, and you're thinking, well, do I want to take 2-cent loss? Are there even enough shares on the bid? If I try to mark it out, or is it, am I just going to get a bunch of slippage? And you just wait there, and while you're waiting, the smarter traders are identifying this is weakness, right? This pause and buying while you're thinking about what to do is a sign of weakness, right? The buyers aren't there. It's just a problem that the smarter traders are going to get out. So now it's going to be 980, or by 980 or by 90, just start to come out a little bit. You're still watching it, and you're thinking, well, maybe I'll just hold this, and what's the chart going to tell me? Do you know? And you're just looking for a good area of support, and before you know it, you're drawing your stop at 50-cent loss, even though you never went into the trade thinking you're going to risk $2,500 on it. 5,000 shares, 50-cent loss. That's $2,500 that you're down. So you're going to risk maybe 200, right? That's how quickly it could happen. Sure, suddenly you're down a ton, and if you've never been in that position, certainly if you've been in that position, you know how it feels. You know how frustrating it is. You see a stock just dropping, you feel like a deer in the headlights. It's like, your heart leaps into your mouth. You're just watching it drop in front of you. The important thing is to recognize that there was an error in that process. And with risk management, this is one of the areas that we can improve. And it's a skill, right? We can get better at managing our risk over time. The more we trade, the more we see these patterns, these setups, we recognize, what, this is something I could just bail out of. Take the 2 cents of profit or the 5 cents of a loss or whatever it is. Just get out of this. It no longer looks good. And remember, that look, I went into this with a 2-to-1 profit loss ratio, and that means I have to sell if I'm down 20 cents. That's not no negotiation, okay? It's non-negotiable. So this gets us into the concept of always know what you stand to lose. So if you don't know how much you're risking in a trade, you're asking for trouble. And anytime you get in something with 10,000, 15,000 shares, most likely you're not thinking about what you stand to lose. Because when you're in something 15,000 shares and it does drop 30 cents, you're down $4,500. I doubt you went into that trade thinking you were risking $4,500. And you were only looking to make a profit of 9,000. I don't think you were looking to risk 45 to make a profit of 9,000. And if you were, and you had the right profit loss ratio, and if you're trading at 50% success, then you'll make money trading like that. Even though you're trading with monster size, you'll make money. But if you didn't have a $9,000 profit target, you definitely shouldn't be risking $4,500. Okay, so this kind of gets to another point that when I was a new trader, there were times where I would take these $5,000 losses, and I would look back at the chart and I think, man, if I was going to take a stab on something and risk $5,000, it should have been because I had the potential to make $10,000. But I risked $5,000 on this stupid stock, buying it at $9.90, and my profit potential on it was only $1,000. That's pathetic. Why would I risk $5,000 to make $1,000? I'm never going to succeed as a trader if I'm going to keep doing this. And I was able to recognize that because, not after, it was after losing probably $10,000-$15,000 in the first instance, and those types of really stupid trades. It was just a painful process. So my recommendation is that you ask yourself before you get into a trade how much you stand to lose. And remember, sometimes the best trade you take, the best trade that is the trade that you don't take. All right? There are times where it's just best to sit on the sidelines. And I know it's hard when you see stocks running up, but the reality is sometimes it's better to just sit on your hands and not take trades if you can't manage your risk. If you can't get a good profit loss ratio, you shouldn't take the trade. You wait for another one, right? Wait till tomorrow morning, the next day. The easiest it's easiest trading from 9:30 after the bell to 10 a.m. Well, it is for me anyway. That's when I make the most money. That first half hour of the trading day. And if I haven't had a really good first half an hour of the day, then I know the odds of me making good trades later in the day is not really good. So the odds of me getting really good trades is going to be the next day. So, like today, I was looking for some trades and I couldn't find. It was a very choppy market, and I couldn't find anything. So there was nothing there. It was crazy. I actually looked at taking some what I call boredom trades, and I know that I'm not going to get it. I'm just not going to find it. So I was thinking I'll just take a little break, maybe come back in the afternoon. Statistically, I make most of my profits in the morning, so trying to get really aggressive and go heavy in the afternoon, I'm just going to mismanage my risk. It's a recipe for disaster. So I decided I'm not going to trade. I'm just going to not trade at all today. Okay? When that's the situation, it's better to sit on your hands and not trade. Take the rest of the day off. Go and do what it is that you enjoy doing other than trading. You have to set stops on yourself. You have to know where you realize, look, I'm able to maintain my composure really well from 9:30 till 11:30, and then around lunchtime I get sloppy, I get lazy. The market's not trading well, and it gets choppier, and I start to get frustrated. The ability to be disciplined is a muscle that you strengthen. So over time, you might be able to sit in the market from 9:30 until 4. But as you're building that ability to be, really disciplined and maintain your composure when you're stressed out, you may not be able to last the full day. Okay? You may only be able to stay at that level of focus for an hour before you need a half an hour break or an hour break, and that's okay. Build up that strength, just like you're building up your strength at the gym or anything else. Just slowly build it up. Don't try to sit from 9:30 to 4 o'clock market time every single day. Okay, it's difficult. It's going to be too hard for most new traders. It's just going to be too hard. Okay, so the question here is, at the open, everything is so fast. So how do I estimate my risk quickly? Right? And this is a really good question that I'm asking now. I've spoke about people in my live chat and things about this in the past. And it's a question that I've often asked a few times. It can be really hard with day trading. And it's one of the hard things is that we have to make decisions on the fly really, really quickly. Okay? It's a matter of, in a matter of 2 minutes, we could be up or down thousands of dollars. So we have to be able to make decisions very quickly. At the open, I have a couple of different techniques for managing risk, and we'll get into this. Some of my actual strategies, we'll get into them a little later, but for right now, I just want to give you a simple answer, which is that I have to set hard stop, okay? And it's not a live stop that's in the system. It's just, for me, it's a mental stop, that this is my maximum pain, okay? This is how far I'll let this thing go before I bail out. So for me, it's usually going to be around 20 cents. If I'm down more than 20 cents on the dollar on most trades I'm taking, even if it's a $90 stock, if you're talking about stocks, mid-cap stocks, if it's a $90 stock, the point, if I'm down 25 cents, I mean, it's just not looking great anymore, is it? So 20 cents is usually a good place just to let it go. I may have mistimed my entry. I may have gone a little too early. I may have chased it a little too high up. If I let it go more than 20 cents, if I let it go to 30 or 40 cents, I start to really stretching it out. My losses are getting bigger, and I'm making it so the odds of me coming out with a good profit loss ratio on the trade are getting lower and lower. So, on the one hand, I would say a 20-cent stop is good. On the other hand, if you're looking at the chart and you see, look, there's a really good level of support and it's 35 cents away, then you could say, all right, I'm going to buy this. I'm going to buy it out of the gates, and right after the bell, and my stop is 30 cents away. I'm going to have to size accordingly. And if I only want to risk $200 a trade, I can't take a 5,000 shares, right? I've got a 30-cent stop. I've got to take 500 or 1,000 shares instead. So you just have to, change your sizing, go a little bit smaller. And now, if you're looking at a stock that has a 40-cent spread, and that happens, I've mentioned this a few times in the past, you've got to watch the spread as well as the action. In that type of a situation, well, honestly, I probably wouldn't trade it out of the gates. You might want to wait. Those spreads are going to be really, really hard to combat. If you're on the right side of them and it's squeezing up, and you're selling on the offer, you can do well, but it can go the opposite direction pretty quickly, and I don't want to get caught. I don't want to see you getting caught in that type of stock going the wrong way. So I would sort of avoid those, super big spread type stocks right at the open. Typically those are going to be stocks that have very light volume, something that only has 50,000 shares at 940, 50,000 shares traded at 940. I'm not going to take that. I keep talking about the importance of volume to day traders. Volume and volatility, we mentioned it in the last lesson. If it's only got that low amount of shares traded, do you know what? I'm just not going to take that trade. I'm looking for something that has usually 100,000 of pre-market volume, 200,000, 300,000. The more the better. So if we don't have good volume right out of the gates, it's already probably not going to be a type of stock that I would typically trade. But that said, if you're managing your risk and you're doing it properly, then you could take stocks that are a little outside what I might consider the right stock, and you're going to have a bigger cushion. You may be able to make a couple of mistakes. So I would just say that if you see something with a really big spread, to be a little more cautious, because when you're estimating your risk on a stock that's spready, it can be a little bit difficult, especially if it drops quickly. So, if something has a 10-cent spread, and it's 15 by 15.10, and I get in at, say, 15.10, I probably still have my stop at 14.90, which is 20-cent stop. Even though you've got 10-cent spread, it still has to drop a few cents to take you out, but realistically, 20, 25 cents is probably going to be my stop. I know it's an arbitrary stop, but the reason I use an arbitrary stop sometimes is it's simply to create, a limit to how much I'm willing to lose. Right now, I don't want to. I want to cap my losses. I don't want to cap my winners. So I don't put an automatic sell when I'm up 10 cents, right? I don't want to. I don't want to cap my winners, but I do want to cap my losers. So sometimes it's best that, let's say, 10 cents to 20 cents makes sense, because it's going to be 400, 800, depending on how much size you're taking, how many shares you're taking. So for me, it's within my risk parameters, for me being comfortable. That's why I choose 20 cents. And if you feel like that's a little too tight for the stock you're looking at, then you just have to size down a little bit, you know, accordingly. Um, change change a little bit in terms of the size that you're actually taking to accommodate, you know, a little bit larger stop or a little bit extra risk. Um, I've talked a little about profit loss ratios, all right? So, what is a profit loss ratio? Well, it's simply what you make on average versus what you lose on average, okay? So, if your winners on average are 50 cents on the share, and that's your winners, and your losers on average are 25 cents, then you've got a 2-to-1 profit loss ratio. Your winners are double your losers, okay? That's the type of profit loss ratio that I want to see you trading with. A 2-to-1 profit loss ratio. A 3-to-1 is better. 3-to-1 is really good, but it's hard to achieve a 3 to. It's really hard to achieve a 3-to-1. A 3-to-1 profit loss ratio is difficult to get, and you know, so a 3-to-1 profit ratio basically says that you're risking 10 cents to make 30. You're risking 15 cents to make 45. I find that hard. I don't usually get a 3-to-1 profit loss. In fact, I'm completely transparent here. My profit loss is about a 3-to-2 at the moment. But certainly whilst you're starting, your accuracy is not going to be as good. So you need to aim for a 2-to-1. Okay, and there's two reasons why. Two reasons why. A lot of times I don't get a stock that makes such a clean move that I can get, you know, a 30 cent or a 40 cent or 50 cent pop without scaling it. Usually when I'm up, say 15, 20 cents, I might put half of my position out on the offer and try to sell a little bit. And adjust my stop to break even. So people who've been watching me trading on my lives, you'll see me, I'll enter a position, and as it's moving up, I'll take half the position off, take profit. I normally say I'm taking profit here. I'll take a bit of profit here. So it might be half my position or a third of my position I'm actually taking off. And then I'll mentally adjust my stop with the remaining size to let's say break even. Okay, so that's a technique that I use a lot. I get myself in the driver's seat as quickly as possible, sell a little bit, take a little bit of profit, get a little bit in the bag. It just gives us a cushion to feel a little bit comfortable, and then we adjust the stop to break even, and that gives us a profitable trade. So because I scale out, it makes it hard for me to get 3-to-1 ratios, and secondly, because of the fact that I'm not usually finding stocks that make really quick moves, it just makes it hard to get that 3-to-1 ratio. So realistically, and most new traders are trading on a 1-to-1, if not worse. So 1-to-1 or 1-to-1.5 ratio when it's all said and done, and you know, you've probably have a look at your own statistics. What have you traded on? You know, I know other people have managed to trade on a 2-to-1 ratio consistently, and I think that's absolutely awesome. But for me, because I'm scaling out, and it's a way of me paying myself when I'm right. So if a stock goes up 20 cents, you know, for me that tells me that I was right and I had the right idea. We're in a stock and it popped up 35 cents on us. That was a really nice move. And I want to pay myself for that. I want to take a little bit of a reward. So I'll sell half and adjust my stop to break even. So when I look at my profit loss, and if you look at my ratios, you look at all my trades, I've got a lot of small winners, lots of small losers, and occasionally I have really nice big winners, right? But I don't usually have, I never have $10,000 winners on a daily. I don't see that on a daily. It's not like I don't do make those trades. It's not like I haven't had those, but it's not as common. Okay, I don't have trades like that because I'm not going in super heavy to start off with in most cases, and holding the position until I get an exit indicator. I'm not. I guess what I'm trying to say is I'm not looking to knock the ball out of the park on every trade. I'm not a home run type of trader. It's not like I get in a trade and it's either going to be stop me out minus 1,000, or it's going to be a $3,000 winner, and it's not going to be anything in between. It's one or the other. I don't trade like that. I don't trade like that. So, if I have 5,000 shares and I'm up 30 cents, that's $1,500. I'm going to take some profit. Now, if it ends up running 50 cents or 65 cents, I mean, you can always say in hindsight, I should have held the whole thing. But how many times have you been up 20 cents and it went back down? And it went back down to even, or even to a 20-cent loss. Right? I mean, how much does that for me is really painful. It's painful to be up $1,500, then all of a sudden be down 750. I mean, for me that gets me really flustered. It frustrates the hell out of me. So I start taking profit and I adjust my stop loss to break even, and that for me is a form of risk management. It's just another part of my strategy that I use. It's also a way for me to help keep my emotions in check. I keep saying about emotions being a clear part of day trading, so I try and keep my emotions in check because I know from myself. I know that when I'm up a couple of $1,000 and I give it back, I get really frustrated. And I don't want to be in a position where I'm trading out of frustration or anger. So I do what I can to avoid that. And one way for me is just to scale out. And I scale out of my winners, take some profit because, look, if something goes up 30 cents and you sell half of it and you book $150 or whatever, and it goes back and you stop out the rest break even, well, you still got that $150. You still got that $150 profit. You still got a winner. So small winners, small losers, and occasionally you get into that trade that just goes perfectly. You get that 40, 50 cent move. It's very clean winner, and you've got a few winners, big winners. Inevitably, there's going to be some losses. Of course, we can't avoid that. You get some losses that are a little bigger than you wanted, but if you're using good risk management, those are hopefully going to be pretty few and far between. Okay? So now the stats on profit-loss ratios. If you have a 2-to-1 profit-loss ratio, that's 33% success is your break-even. That's your break-even point. A 1-to-1 profit ratio, 50% success is your break-even. Then a 1-to-2 profit-loss ratio, which is negative profit-loss ratio, it means that you make $20, but every time when you win, but you're risking $40. So your losers are going to be bigger than your winners. It makes no sense. So with a 1-to-2 profit-loss ratio, 66% accuracy is your break-even. Now, I've already said I've been trading well and I'm profitable, and my accuracy is a little over 70%. So for you to be approaching that 66% as your break-even level, that's not a good place to be in, okay? Obviously, if you can be at 2-to-1, have a 2-to-1 profit-loss ratio or a 3-to-1 profit-loss ratio, you're really putting the odds in your favour. I mean, you can see how dramatically that changes. It changes the outlook and the potential for you as a trader. So if you're only making 10 cents on average, but you're losing 20 cents, um, you've got to be right 2/3 of the time. You've got to be right 66% of the time just to break even. That makes it really hard to succeed. So the best thing you can do is only take trades where you can get a tight stop and you know you're risking half of what you're potentially going to make. If it works out for you, you're getting a 2-to-1. You're getting a 2-to-1 profit loss ratio. Okay, that's putting the statistics in your favor. So that means you have to know your stats, and you have to know how to calculate what your stats are. You have to know how good you are, and you need to know your percentage of success. What's your average winning rate? What's your average loss? You want to always aim to improve this ratio, because even these small adjustments, an extra penny here, an extra penny there, they can amount to really big dollar and percentage differences. So knowing your statistics is really important, and that's why I encourage everyone to track your trades on some kind of document. You can use an Excel document. I use TraderView, which calculates a lot of the what's the word I'm looking for? TraderView calculates a lot of the a lot of the statistics for you in a nice graphical format. So you've got to if you can sort the data yourself in an Excel spreadsheet, great. But I do recommend take a look at TraderView. Okay. I'll just pull across some of my statistics on TraderView and show you what I'm actually talking about here. Just give me a second whilst I'll pull this across here. So this is my TraderView, and if I go into the report section here, we can see here, so we'll go into the detailed statistics, and I can see here what we're talking about here with 76%. So I'm working on a 76% accuracy rate. But if we look at my average winning trade versus my average losing trade, I'm actually looking at a 4-to-3 ratio there. So my profit loss is not as good, but my accuracy is making up for it. So that's what's giving me the profitability. If I look at this year, this last month, for example, where I had to take a lot more, be a lot more cautious, because I started with a small account, and we did that small account challenge, and we've grown that account from $5,000 at the beginning of the month to over $100,000 as we're approaching the end of the month. So if you look at the profit loss ratio here, then it's a much better one here. So we're looking at a 3-to-2, as I stated. The profit loss ratio is 3-to-2, and the accuracy is over 70%. We're looking at 73% here. So this is what I'm looking at right now, and this is TraderView. It's great. You can do it on an Excel spreadsheet. You can do it, calculate it yourself, however you want. But I say journal and document every single trade. It's important that. It's important that you do that. If you need help with what to put, if you just want to do it on a spreadsheet and you need help, just let me know. I do have some spreadsheets that I can let you have. It gives you kind of a body of the trades, and it allows you to start tracking the information directly yourself. So I would certainly look at journaling and logging all of your trades, either in a spreadsheet or do it with TraderView. Okay. If you're doing it with TraderView, even documents the time of day that you've done it, how long you've held the trade. It gives a lot more information than you're going to log on a spreadsheet. So it helps you with that risk management piece as well. So just want to just want to be conscious of your profit and loss statistics. So, like I said, for me, I'm currently a 3-2. I'm aiming for 2-1. I'm not perfect, but because I've got a high accuracy rate, I can get away with the with the 3-2 and the scalping. You should aim for 2-1, and that will allow you to be wrong more than you are more than I am, until you actually get better at spotting the setups as well. So aim for that 2-1 ratio. I still try to get that 2-1 ratio as well, and the fact that I scale out it basically means that I don't always get that 2-1 ratio. Okay, it's what you're looking for is to get something that's a scalable strategy. You want clear profit and loss ratios, and as I've just highlighted there, it's huge in risk management. It's absolutely huge in risk management. So you want to be looking at, I'm taking a trade, where's my exit point here? So where's my take profit? How much am I going to get out of this? And then you can start saying, okay, well, if I'm going to get X, I want X over 2 is how much I'm prepared to risk. Okay, so if you're able to take $10,000 of risk, it's because you knew you had the potential to make $20,000 of risk. Now there are times when I'm going to sell sooner, and I'm going to take what's going to be just say 5 cent or a 10-cent winner. It's not going to be as much as I wanted originally. But if we've got an exit indicator from the charting, from the technicals, and I'm looking at the technicals, it's looking weak, and I get an exit indicator, then I have to bail out, whether it's a win or a loss. Sometimes we get an exit indicator and we've just got to get out. So that's fine, right? That's fine. You've got in the trade knowing it had potential, and it had potential to go for that 2-1 profit loss ratio, and that's your trading plan. And we'll go over that in a future lesson. But you're going to be aiming for 2-1, but we're going to run the calculations expecting that you only hit 1.5-1 or 1-1. Okay. You can see the percentage of success that you have to be just to break even. And this, when we keep saying how many people, how many traders are not profitable, they lose money. This is what we're talking about. That their accuracy suffers, and they're not running profit loss ratios in the right way. They're not managing risk in the right way, and that's why they end up being losers. And a 1-2 ratio, for example, that or 1.5-1 is even better than 1-2, but you still have room. What you're looking for is a cushion to be a bit more realistic. So sometimes we're going to take profits sooner. That's all I'm saying. Sometimes you see the exit indicators, you can take profits sooner. Okay, that strategy really works well for me. The either taking profits maybe a little bit sooner than I need to. Taking profits once I see an exit indicator, just getting out, cutting the trade if I see an exit indicator. This can actually cut your profits a little bit, or you're scaling out. This can actually affect your profit loss ratios in some way. But as long as you are maintaining a positive ratio, that's what I've always found works well for me, both psychologically and financially. So it's the way I'm trying to teach it to you. Okay, but I'll say it again, 2-1 is the golden ratio. So never take a trade that doesn't give the opportunity to double what you're prepared to risk. You always have to ask yourself, what's my stop and how much am I risking on this trade? You have to know how much you're putting into this trade. Okay, the golden ratio, 2-1. So before you hit the buy order, you're going to know that you're risking $5,000. You want to be making 10. Okay? If not, is this the day you're going to have a blowout? If you're risking 50, that's fine. If you're risking 50 to make 100, if you're risking 500 to make 1,000, that's fine. But always make sure you're managing your risk properly. So when we have a bigger window of potential profit, you have a better opportunity of capturing a winner, right? So if your profit potential on the stock is only 10 cents, then you've only got a 10 cent window, whereas if your profit potential is 50 cents or 60 cents, then even if you only get 30 cents, and you've only got half the potential profit, you've still got a nice profit, right? So we want to look for those bigger windows, those bigger opportunities, and that's why I focus so much on the gap and go strategy. I keep talking about, you know, the gap and go strategy and some of the breakout strategies that I'm looking for. But the gap and go is really profitable for me because a lot of these stocks are gapping up with momentum, with a news catalyst that can, you know, it encourages it to make huge moves, you know, 10, 15, 20% moves in half an hour, right? So that gives us a big window of potential profit, and we're not going to capture all of it. It's nice when we capture a large chunk of it, but you know, we're not always going to be able to guess the top and bottom of these moves. So we do have a better opportunity of catching a big winner than if we're just trading choppy sideways markets, but we're not always going to catch all of the move. Okay, the sideways markets tend to be the markets where we're aiming for the kind of 10 cent move, right? So we want to set our sights on some of the bigger potential winners. You know, it's not that we're looking for a home run, but we do want to trade stocks that have the potential to be big winners. We do want to trade stocks to have a home run. Last week I traded one stock and I got in for, and I was looking to take profit after a 10 cent move, and it ended up being the biggest trade of my career. The biggest single trade of my career, because instead of getting 10 cents, I got $3 on the share out of it. So the potential was there. And that is there. So if potential's there, if it doesn't have the potential to be a big winner, then why are we going to take our risk on it? You know, maybe it's better to just sit it out and wait for one. If it's not going to have the potential to move big, why not wait for one that is? Now, I've told you that my accuracy is in around between 70 and 75% most of the time. Okay, so it allows me to be I employ some scalping strategies. I'm not a scalper per se. I do scalp from time to time, but I'm a pattern trader, and I trade the patterns and the breakouts. But I do exercise and I scalp momentum from time to time. Now, the thing is with scalpers, the majority of people that trade scalping strategies usually have a negative profit loss ratio. And we discussed that a couple of slides ago. All right. So if we talk about risk in the market, and you know at a certain point that you have to ask yourself, what type of trader do you want to be? What type of trader are you, or what type of trader do you want to be? Because some traders, and as I say, I trade on the 1 minute and the 5 minute. I underpin the action on the 1 minute with the 5 minute. Some like to trade the 5 minutes or 15 minute charts or 30 minute charts. They want to go a little bit more slowly with the trades, and there's other traders, like, you know, as I say, the 1 minute and the 5 minute are more than sufficient to move in and move out quickly with larger positions. So if you're a scalper and you're taking 3 cents profit, 5 cents profit, etc., typically you're going to have a negative profit loss ratio, because realistically you're going to be risking more than your profit levels. So when I scalp, I'm still looking for those momentum stocks, and I want to see it surge, and I'll scalp a big move. Okay, so I'm not by true definition a scalper. I'm a pattern trader. But if you're only taking 3 or 4 cent profit on your winners, it's hard to keep your losers under 5 cents. I mean, it happens, you just get a 10, 15 cent loss, and you've got a negative profit loss ratio because you're scalping. Just bear that in mind, okay? You're going to have to be right even more than I am. And I'm not saying you can't do that, but it's taken me a long time to get the accuracy that I have, and you need to learn your skill set. You need to hone your skill set and build your accuracy up. So on the one hand, scalping might seem like a quick way to make money, and you've seen me do it, but because you know how often we're up 5 cents and 6-7 cents or whatever it is, and we're up 5 cents on a regular basis, but it doesn't cover the losses a lot of the time. So 5 cents is your average winner. It isn't going to cover the losses for you to be right, only 50% of the time, if you're going to have to be right 70% of the time to keep up with the type of profit loss ratio. So that's why it's really hard to scalp. It looks easy, but it's not. It's one of the hardest strategies. Being a scalper sounds easy. You see a lot of people doing it live, and they make quick wins and things. It looks easy, but trust me, it isn't. Don't be a scalper. You can't afford it. You will blow up. You'll blow up your account trying to be a scalper. It's hard to maintain those kind of profit loss ratios. Getting that level of accuracy. If you're not good on technical analysis, if you're not good on seeing the setups forming, if you're not good seeing the support and resistance levels in your mind without actually plotting them out on the graph, it's going to be very difficult. It's going to be very difficult for you to be profitable. Okay, so we're going to learn in the next few lessons that if you can apply the strategies that I'm going to teach you, you can apply them to 5-minute charts, 15-minute charts, 30-minute charts. The chart patterns are going to remain the same regardless of time frame. It's you've just got to decide what time frame you're going to apply them to. Okay, and the strategies for most part, again, they're going to remain the same. You can apply them to different time frames. So you just want to go with whatever suits you best. So stretching out the time frames to 5 minutes and the 15-minute as opposed to the 1 minute and 5 minute or the 30-minute charts. Typically, you're going to be less of a scalper and more of a mid-term, longer-term trend-based day trader, closer to swing trading, I guess. So you're going to be a trend-based day trader, and that gives you a little bit more of a cushion on trades that are moving a little bit more slowly. You may be able to take a few of them at the same time. You see me, I can only take one trade at a time because the moves are so. I'm taking the moves so quickly. So that could be a good approach for you. Maybe have a look at that. Especially a lot of beginner traders favor that longer time frame, the more confirmed trends to look at. So maybe have a look at that in the first instance before you jump in with the 1 minute and 5 minutes. All right. Now, what I also want to talk about. So what I also want to talk about a little bit is balancing your risk. And this is an area where I really needed help. When I first started off, this is an area where I absolutely needed help. And say you take 10 trades and you're risking $100 on 9 of them, okay? But then you go on the 10th trade and you risk $10,000. You go big. It doesn't matter that you won the first 9. Even if you have a 90% success rate, it doesn't matter. You may say, you make, let's say you even made $1,800 on those first 9 trades, and you were trading on a 2-to-1 profit loss ratio. Then on the 10th trade, you lost 10 grand. It doesn't matter, right? So it's okay to adjust your size based on feeling, good, or a little uncertain about the market or about a particular trade, but you want to balance your risk, at least relatively. So you balance it between trades. So you want to risk 2 to 400, 500 to 700, but what you don't want to have is one trade where you risk, say, 5,000, and another where you're risking 200, because then when you have winners, all those $200 trades, they're not going to cover that $5,000 loss. So you need to balance your risk. It's important that if you're making base hits, and the base hits mount up, and I keep saying, it's not about swinging for the fences all the time. If you make base hits and you get a bit of a cushion, and then you do swing for the fences, you need to. You can't then have a big loss and it just wipes away all your profits. You give away all back your profit and then some. Okay, so you need to be balancing risk. To become detached from the emotions of every trade. You don't get if you don't get emotionally attached to any particular trade, because it's just another trade, right? It's just $50, $100. Who cares? This isn't the trade that your whole career is going to be hinged on. It's not this trade that has the potential to turn everything around. We don't take trades like that. That's not what we're looking for. You don't want to be making. You don't want to be looking to make days where you're making $100,000. That's not the type of trader that I am, and also I don't expect that's the type of trader that you have. Don't be looking for those big swings. Not, if you get them, it's great, but don't be looking for them all the time. So I don't go looking for them, and conversely, I don't have days where I lose 100,000 or 200,000, right? Just those small, steady gains, day after day. That's my goal, and it works for me. It makes me feel good. Managing that risk. Those gains, that add up across the day. So one big loss can wipe it out. You're not balancing your risks. So gambling can be a problem for a lot of traders. In fact, a lot of people outside of the trading community look at trading and think it actually is gambling. And a large part is because a lot of gamblers get into trading and lose money. And why is that the case? I mean, for sure, a gambling mindset can be a problem. Why is that a problem? Because gamblers think about profits, whereas traders, successful traders, are thinking about risk. They're asking themselves, what's my stop? They have a mental stop. They know how much they're risking in each trade. If you're going to take 17,000 shares and risk 10 cents on the share, that's $1,700. Okay? It's because it's got to be because you had the potential to make 20 cents or make, just shy of $3,500. Right? $3,400. It's really important to understand. It can be tempting at times to get into this kind of gambling mindset where you start getting really aggressive. But if you start to feel that way, you need to get up and walk away. You need to stop. Take a break from trading, go for a walk the dog, go and spend an hour at the gym, whatever it is. Even just walk away and pack up for the day. Just walk away. Let that $500 loss or whatever it is that's getting you frustrated, just let it be what it is. It is what it is. Show that you're stronger than that urge, and show that you don't have to be really aggressive. It's really, really important. Be good at being wrong. I keep saying this, and I don't, when I'm trading live and people are watching me trade live, I try to be as transparent as possible, because if I try and show people that I'm winning every trade, and I'm not having any losers, it sets unrealistic expectations first and foremost. But it's a falsehood. Most traders, in particular beginner traders, lose money. Why do they lose money? Because they lose more often than they win, and they lose bigger than they win. So even the best traders still lose. Okay, you've got the profitable traders are they just end up being good at being wrong. What does that mean? It means when it comes to risk management and day trading in particular, you're going to have to you've got to recognize that you've not got a crystal ball. Not every trade is going to go your way. Okay, I know none of us like being wrong, but it could be a hard job if that's your mindset. I have an extremely high within the trade. I have what's considered an extremely high accuracy. I'm over 70% accuracy. That still means I'm 30% of the time I'm still wrong. You know, that's a third of the time, a third of my trades I'm still wrong, but I'm still making money. I'm wrong a lot of the time. But when I first started trading, I didn't like being wrong. I don't like being wrong, but I'm wrong every single day. Every single day I do something wrong, and you know, I look at a trade, and occasionally I'll take a trade, but even though it's not set up in the right context that it's taken, and I kick myself as I'm taking it. I know I shouldn't be taking it, and you know, it goes against me, and I get out for a loss, and I'm thinking, I knew I shouldn't have taken that trade. I knew I shouldn't have taken that trade. Get good at being wrong. Get good at admitting when you're wrong is probably a better way of saying it. Saying you're wrong is I mean, if I take a loss, if I think the trade is going to go up and it goes down, I mean, am I wrong? I mean, did I make a mistake? You know, it's just the way it is. If I'm trading it right and I'm getting in on the right setups and the right entry points, maybe for a breakout or you know, a break of resistance, or I'm getting in a pullback to support. If I'm getting in at the right time, but it fakes me out, so I am wrong and I make a loss, am I really wrong? You know, the trade is not going to go your way all the time. That's just the way it is. That is just the way it is, and you have to learn to cut that loss. So when you're down 200 and you cut that loss, that's the right thing to do. Even though it's a loser and you know it's going to show on your percentage of success that you were wrong on that trade, it's still the right thing to do to cut that loss. You've got to learn to be good at that. You've got to learn to cut your losses and cut them, keep them small. Okay. It's okay to take a lot of small losses and get comfortable of taking 5, 10 losses and just walking away. You brush it off. It's no big deal. It's easy to recover from a small loss. You know, you never know when you have a big trade coming. It's just around the corner. It could be the next trade, right? But you don't want that next big winner to have to make up for stupid mistakes that you've made. When you get a really nice news to trade on, you know, and you make a quick 500. I don't want to be one that's held way too long and took a big loss. Took a too big a loss, because I want to be putting money away in my pocket. I want to be profitable, right? So learn to be good at just walking away. If a setup doesn't feel right, get out. It's okay. There's a lot of times where I sell flat for a scratch. A scratch trade is where you actually make nothing. You get in and out at the same level, or a $20 loss or a $20 gain because I'm not feeling it, and that's okay. We have enough setups that go almost immediately and have a very clean resolution. That if I get in something and it's not looking quite right, I'm just going to get out. But you know what? I'm going to be one of the first people to bail out. You never want to be rushing to the door with everyone else because you're going to get trampled. You're going to get a bad order, you're going to get a horrible fills, bad slippage. So if something doesn't feel right, just walk away. Be the first to step back and say, look, you know what? I'm just going to step back. And if it runs without you, so what? You're managing your risk. You're taking precautions. You're managing your risk and you're doing everything you could to survive in the market while you continue to learn. Okay? So, you're up $100 today instead of 1,000, whatever. Green's good. You're up. That's good. You're down only 100 instead of 2,000. That's good, right? That's an accomplishment. So, especially with a day like today, when the markets are really choppy sideways and it's difficult to trade, when they're bad, anyone that got away without being totally destroyed is doing something right. So, these are all the rules that I have in place to help me reduce my risk. Trading is risky, we know that, but we have to manage our risk. So when I talk about risk, next slide, there's really 5 types of risk that I think about. There's 5 types of risk that we have to take into consideration. One is the exposure risk. Okay, somebody asked me how much do I trade on any given trade, and the simple answer is it depends on the trade. How much am I trading on any given trade? I need to know that. So that's my exposure risk. That's how much money I have in the trade. It's different on every trade, so I can't say from one trade to the next that I'm going in with a certain value on that trade, how much money I'm going to put in. But when I'm taking a trade, I know how much money I have in the trade. Okay? I mean, let's just say, for example, I buy 10,000 shares of a $5 stock. Then I've got $50,000 on the line, right? That's my exposure. That's kind of like, that's my money that's in the trade. Realistically, where we usually take our losses is just between where we buy and where we sell, right? So the second level of risk is the distance between your entry and your stop. Then you're going to multiply by your share size, okay? So that's the risk we're going to talk about most of the time. How much you're risking on this trade. So don't tell me $50,000 because you got 50,000 in the trade. If you have a 10-cent stop and you've got 10,000 shares, you're risking $1,000, right? That's the risk that I'm almost always going to be thinking about. What's your stop? That's how much you're risking, okay? Now, we also have slippage. And slippage is when you go and hit the sell button and instead of getting filled at 9.80, you get filled at 9.75. That's a 5-cent slippage. Okay, a little bit of slippage. There are some stocks where slippage is going to be a bigger problem than others. So I'll cover that off a little bit later in another lesson around stock selection. So stick around for that. But you just know that there's such a thing as slippage, and it can be a little bit of a problem. So we do have to be a little bit careful on that. Fourth is the float. And we look at this before we actually start trading a stock. We look at the float, we look at the volatility, and they're interlinked, okay? So stocks that have a low float are going to be more volatile. Now, what is the float? The float is the number of outstanding shares available to trade. So a stock that has very few outstanding shares available has very little supply. So if there's a lot of demand, that stock's going to go crazy. It'll go up very quickly, and it can also just as quickly go down. It can be a lot of fun to trade these kind of stocks. Low float stocks can be a lot of fun. The volatility, you can get big swings. They can be quick to trade, but that low float makes them very volatile and potentially a lot riskier. So it's just good to know the float on a stock, which is when I look at my Benzinga. I'm setting up my Benzinga charts and scanners. I'm setting up my the stock, and I'll cover this a little bit more in stock picks. But I'll click on the ticker, and I'll go into key data and have a look at the float size, because I know for myself that can impact the volatility of the stock. Okay, so knowing the float that you're trading is a way of measuring that risk. Then the fifth element of risk is just the time, the time in the trade. So, and this kind of comes into the exposure. If you're holding $50,000 worth of stock for 8 hours, or 8 days, or whatever it is, there's a certain amount of risk involved, and there's always a potential of something bad happening. News coming out, or an SEC halt, or there's just that potential. And the longer you hold a stock, the more you're exposed. So it's has a higher likelihood that there is an external factor that you've not taken account of. And these are the types of risks that I'm looking at as well on a daily basis. And I'm thinking about this when I'm preparing my day, and I'm looking at my watch list. But typically my focus is going to be all right. I'm getting in this stock at 9:32. 9:32 in the morning. That is not $9.32. I'm getting this stock at say 9:32, 2 minutes into the trading day, and I'm gonna be buy it at $5. Where am I going to sell it if it doesn't go in my favor? 480, 20 cents, right? 20 cents risk. That's what I'm going to focus on most of the time. Okay, and will I have slippage on this in particular stock? I will. So instead of taking 2,000 or 3,000, I'm going to take 1,000 or 1,500 shares. I'm going to go a little lighter. Okay. You've seen me adding to my position, either buying the dip or adding to my position as it's ripping up. I like to add to winners, not to losers. Okay? A lot of traders, be very careful about averaging down. A lot of traders do this averaging down, and if you go into some apps and some platforms that have these copy trader functions, and you're looking for a trader to copy because you're just beginning, and you look at the statistics of the success rate of these traders, and they're trading at like 95, 98, 100% accuracy. Be very wary. Be very wary of those traders before you actually do copy them, because more often than not it's those types of traders that are averaging down to make their position a winning position. Okay, averaging down is, in case you don't know what averaging down is, and I apologize if you do, but if you don't know what averaging down is when you buy something at $5, for example, and it drops to $4, and you go and buy another 2,000 shares at $4, because that brings your cost average down. Yeah, right. So 2,000 shares at 5 and 2,000 shares at 4, your average is 450. So there are traders that will average down if the stock goes against them. I would rather just bail out. Personally, I would rather just bail out. If it's going down 20 cents, just get out. I don't want to get in a situation where I'm having to average down and work my way out of a losing position. it's time consuming, it's distracting, it's taking my attention and focusing on it, and it's trying to get out of a bad situation instead of finding the next winning trade. If a stock dropped down to 50 cent or a dollar, it's immediately, it's something I'm not happy about. So it's not a stock that I probably want to be trading, because I get frustrated. It's already hurt my feelings, if you will. So I don't want to be trading because of what it's just done to me. So the best thing to do for me is just to walk away, take the loss and walk away. Right? Occasionally, and I mean occasionally, I'll get into a situation where I do decide to average down, but it's not common. It's not common practice. I don't do it all the time. I'm not saying I don't do it, but because I have been known to do it. But very often, if I have done it, I've done it into support. So I'm looking at why I'm actually doing that. I'll average down into a support area. Maybe I've got in a little bit. I'm buying a pullback, and I buy in a little bit too early, and it pulls back a little bit further, and then I'll average down into support. But again, I'm really looking at, if I'm talking about that 20 cents, and it goes down to 10 cents into a support level, like the volume weighted average price, or previous low of day, or something like that, then I might add to the position, buying the dip, if you will. But if it's a losing position, if it's gone down that 20 cents already and it's beyond, we're not looking at any support areas to buy into, I'm almost never gonna average down. It's something, if it doesn't look right, I get out. I'd rather take a small loss, and I don't usually get in a situation where I'm looking at really massive losses, simply because it dropped a lot and I had to average down, and then it dropped more and I averaged down more, and you end up spiraling. This is how a lot of traders blow up their accounts. So just don't add to losing positions. If you add another 2,000 shares when it's down at $4 and it drops to $3.50, and you're adding another $1,000 into that loss, which was all you were making in a bad situation, is you're just making it worse and worse and worse. It's already a bad situation. So if the pattern isn't working, if the market's not going in your favor, the best thing to do is just get out. Cut your losses. So, now a lot of new traders struggle with selling the winners too soon and holding their losses too long, right? And that's when you get into a negative profit-loss ratio. We're talking about what scalpers do in terms of having a high accuracy to be profitable. You've got to accept, as a beginner trader, you're not likely to have such a high accuracy. You're going to pick your trades, and you're going to make a few losses, and you're going to make a few wins, and your accuracy is not going to be as good as someone who's an experienced trader. But what you'll find is that a negative profit-loss ratio is when you're selling your winners, you sell them all for 5 cents profit, and your losers, you're holding them for 10, 20, 30 cents, that kind of thing. You're not letting your winners run. You're cutting them too soon, and then you're holding on or even averaging into your losing positions, so you got bigger losing positions. The real thing is here, again, is to set your stop and follow it. Don't allow yourself to take those big losses. Set the stop and follow it. And if you need to come up with a system of punishment for when you break one of your rules, you can do this. Write down your own rules of trading, and if you break one of those rules, set yourself a punishment. You have to do 10 push-ups or something, whatever it is, or that you have to take a shot of vinegar, or whatever you don't like doing, a spoonful of mustard or something. If you break one of your rules, punish yourself. You'll learn. It's like the you know, rewarding good behaviour and punishing bad behaviour. When I was a new trader, I said, okay, every time I make a mistake, I'm going to do 10 push-ups. Either I'm going to be in amazing shape, or I'm going to be broke, or I'm going to be in horrible shape and I'm going to be rich. If anyone's ever seen me lately, one of my Instagram profiles is dad bod travels, dad body travels, because I've got a dad bod, and you work it out. You know, I wouldn't say I'm rich, but I'm not in shape and miserable. Let's just say that. Okay. I mean, I did push-ups for a while, and I do have quite a powerful build. But mind you, I did play rugby for quite some time, so that adds to that. But what I'm saying is, I came up with a system where I really didn't want to do the punishment. So I was like, I best not keep making these mistakes, right? And that's a good way to do it. So you can also do a reward system, reward or both. Reward yourself when you take a trade and follow the system to a T. I mean, making money is its own reward in a lot of cases, but give yourself a little bit of chocolate or something, or whatever it is, a jelly baby or something. Reward system or punishment system is got to be as good as the person that's following it, though. So don't write it down and not follow it. Don't put something in place and not do it. Be disciplined. Discipline yourself. Follow your rules. That's what I'm saying. Okay? Whatever works for you. A lot of different techniques you can try and use, but the most important thing is you set your stop and you follow it. And with the winners, you don't sell if you're up 5 cents and there's no exit indicator. Come on, let's face it. If there is no exit indicator and it looks like it's just going to keep running, what are you selling for 5 cents for? What are you selling for? If there's no exit, if it starts to pull back, then maybe take some profit. But if it's just moving, why are you taking profit? If there's no exit indicator, why are you exiting? Why sell for 5 cents when, it's not enough to justify the trade. You got in thinking that it could go to 30, 40 cents. So just, give it a shot. Give it some breathing room. Which brings me to this part. Plan the trade. Plan the trade before you take it. You probably heard me on the streams talking about have the strategy before you actually take the trade. Plan the trade. It's important. If you intend to scalp, don't turn it into a 5-hour long hold, right? And if you attended a short-term day trade, don't turn it into a swing trade overnight. Don't average down because you weren't planning to. And don't add to a bad chart pattern. Because, who does that, right? Why would you do that? That's a bad idea. So, another thing. Okay? When we're determining profit targets, we'll review this more when we look at chart patterns, but we're going to look for nearby areas of resistance and just use those roughly as potential profit targets. I'm going to look at those areas of resistance. You can look at moving averages. You look at the VWAP. You can look at previous confirmed areas, previous highs, bottom bounces. There's a lot of different areas that you can be looking at. A recent high on the daily chart, for example. Anything that we could find that could be a potential area of resistance, I'm going to look at as potentially, that's going to be my first area to take profits. And if I get there, it's going to be my first area of resistance. So if let's see it like, if my first area of resistance is only 8 cents away, it's probably not worth taking the trade. I want to be looking for those big pockets so I can give the trade a bit of breathing space. I want to be looking for pockets where we don't have any resistance so we can get $10. Okay, we're getting into a big window, and that's where we can get the short squeezes. That's where we can get big moves. Now, there are some traders with 7-figure accounts that can basically buy something anywhere, and if it goes up, they make money, and if it goes down, they'll just add to the position, and if it goes down more, they'll just add some more to the position and keep adding to the position until eventually it starts to go up, and they can keep doing that until they can get a profitable situation. But that's not going to go out. That's not going to work out for most traders. If you've not got a 6-7 figure account, don't add to those losing positions. Most people will. It'll be a losing position unless you've got a multi-million-dollar buying power. It's just not going to work. So if you're a multi-million-dollar trader, great, good for you, and I guess you can do that. But I mean, really, are you going to put a couple of $1 million on the line and buy in for a couple of $1 million just to get 5,000-6,000 back? That's terrible risk and reward, really. And if you had that kind of money, it's just not a good strategy. It's just not. Okay, so the best thing to do is just cut those losses and let them go. This chapter on risk and reward, the biggest thing that you can take away from this is cut those losses early. Okay, now we'll get into how to mitigate risk by trading just the strongest stocks. Right, that's going to be the next thing we talk about is how to choose the right stocks to day trade. But for now, we'll just leave it at aim for that 2-to-1 profit loss ratio, and remember to always take your stops. Okay. You trade the strongest stocks, you trade the strongest patterns, and we'll cover that in a later chapter. One other area of potential risk I've not covered off yet, and it can be reward as well, as I've seen and people have seen me get benefit from, but you need to mitigate this as well. One other area of potential risk is when a stock is halted by the SEC. What do I mean by that? So this can be a little bit nerve-wracking if you're in a stock and all of a sudden trading stops. So the SEC, during market hours, they can put a volatility halt in place where they will stop trading, either selling or buying of a particular stock, if it moves 10% in either direction in 5 minutes. It results in what's known as a circuit breaker halt, and the stock is halted for 5 minutes. Okay, that can be pretty scary sometimes, because you can't trade it, you're locked in, and I mean there's a few different reasons why it can halt. As I say, volatility is one of them, but also if there's it can be halted pending news. So if there's a news press release coming out as well, pending news halt, and then it can be longer than 5 minutes. It can be as long as if there's a conference call coming out, they can halt it for the full duration of the conference call. That can go on for a couple of hours in some cases. Okay, so halted pending news. So if a stock's just trading totally normally and then all of a sudden it's halted, and you go and you look it up and it says it's halted pending news, you don't know what the news is. It could be that the CEO's resigned. It could be that they're going to file for bankruptcy. It could be that they're being bought out. We don't know. We just don't know what it is. And there's nothing you can do in a stock that's halted. that can be a little bit scary. It can be a really scary situation. It's one of the reasons that if I can avoid it, I don't like holding stocks for real long periods of time because of the potential risk of a halt. How often does it happen? I mean, I don't know exactly statistically how often it happens, but we've all seen it happen, and it's just something that you have to be aware of. Okay. Now, a stock halted pending SEC investigation is really, really bad. I think you can work out. You can work out why that potentially is likely to be bad news. But this typically happens when there's a little bit of corruption or something taking place. A lot of the case, pink sheets or penny stocks, you'll get this happen more often there, as opposed to more regulated stocks. We're not trading penny stocks, and we're not trading the pump and dumps, so we really don't have to worry too much about that. It's something that's really common with the penny stock traders, but that's not my cup of tea. And if you want to trade that, that's up to you. And if you do, it's something you need to be aware of. But I'm not going to be covering penny stocks in this course at all. So just be wary that halted pending SEC investigation is bad news. So I'm not going to worry too much about that. If you follow the strategies I'm going to teach you, you won't have to worry too much about that. Okay. But anyway, what would usually happen if a stock is halted is pending investigation is it could be halted for a couple of weeks. It's not just going to be halted for 5 minutes, 30 minutes, or even the rest of the day. It could be halted for weeks, weeks at a time. And when it reopens, the likelihood is it's going to be gapping down. It's going to be opening, and it could be 50% of the stock's value could have been wiped off the price. So anyone that's in it is going to get stung. They're going to get destroyed. Basically, it's the last thing you want to see. The most common halts are volatility halts. And like I say, if it's moving 10% in 5 minutes, set off that circuit breaker. And typically a circuit breaker is a 5-minute halt. Occasionally it's 10 minutes. I've seen them 15 minutes. I got caught in one last week. It was 30 minutes. The reason for a volatility halt, the 30-minute halt is extremely unusual, I've got to be honest, and I was getting nervous because it was a long halt, and whilst it was saying volatility halt, I was thinking it wasn't, and the code that was showing on my level 2 was wrong. But the fact it went 30 minutes, and when it gapped up 25%, it made me a lot of money, so I was happy about that. But the reason you get volatility halts is it's designed to slow down the volatility in the market, okay? So stock drops 10%, it's halted 5 minutes. It'll reopen, and then it starts trading again. If it drops another 5%, it drops another 10%, it'll be halted again, okay? So with these volatility halts, they often happen when a stock, all of a sudden there's breaking news, and stocks will be halted, pending news. If it's released by the company, but news comes out, say news comes out, I don't know, Tesla car caught on fire, something bad like that. It's not going to be something that's released by the company. It's just going to be breaking news, world events that cause a lot of volatility. So in those situations, we can see stocks that make quick moves. And as you know, I'm a day trader. I look for volatility. So this can provide a potential for a trade. When it reopens, we can take these trades, but they're going to be riskier. And basically trading breaking news, and I'll go over my breaking news strategy later in the course, but the potential for a stock to get halted is something to be aware of when you're trading it, and it will happen from time to time. When you're holding it through a halt, if I've been in stocks that are halted, and there's just nothing you can do. There is nothing you can do. Um, you've just got to wait for it to reopen. What you can do, if you're trading on a platform, I like to trade on Dash Trader Pro. If you're trading on Lightspeed or Sterling Pro, or there's a number of different platforms out there that you can do this. You can set a system stop, a trailing stop loss or something like that. So if you're expecting it to resume up, put a trailing stop loss. It can help you minimize any risk. But other than that, there's nothing you can do. You just got to wait for it to reopen. I mean, I've been in the 5-minute volatility halt, and when it reopens, and the trading comes right back, and usually, if a stock's halted while it's shooting up, it usually opens higher. Rule of thumb: doesn't always. It sometimes opens sideways, but if you've got the right setups. And it does go, and you've got high volatility and good momentum into the halt. It very often it'll reopen, it'll gap up a little bit, and it'll keep going. Okay, it's not always the case, but that's what oftentimes happens. So if the news is good, so the stock is going to keep going up. Some I've seen stocks go up, say 30 cents. And they're halted 3 times on the way up. Halt 1, 2, 3, and you just hold the whole time. And when it starts to come, you just bail out. When it starts to come back, you just bail out, and you bail out for a nice profit. If I go back to my big trade in mid-February, I took a trade. The setup was right. The momentum was coming in. And I took a trade. We broke a resistance level, and I took a trade, and it went up 6 cents into a halt. Now I was looking to take profit at 10 cents, and it went up into a halt. And when it resumed 30 minutes later, it was a $12 stock, and it resumed at 15.86. That's extremely unusual. And I made a huge amount on that on that gap up, because I'd set that trailing stop loss as well. So it moved up slightly, and then it flushed down. I got a very poor fill, but the 50 cent stop loss. But I think I lost about 80 cents on the high, which I wasn't too bothered about, because I still gained $3 a share, which is a very, very good profit there. Okay, so. If you're holding a stock and it didn't reopen for 3 days, and you're on margin, I suppose your broker's going to give you a margin call. He's going to probably give you a call, find out what to do. I don't really. I've never been in that situation, if I'm being honest. So I don't know. I would expect you probably get margin called from your broker if that's the case. If you can't trade until it reopens, and it's going to be overnight, and it's beyond your overnight margin, you probably get margin call. Your broker might just liquidate your position right there. I don't know. I've not been in that situation, but it's worth speaking to your broker on that one. Just be aware of that. If you're going to hold a position overnight, you need to make sure that your overnight margin is going to cover that position as well. So for the most part, I'm able to mitigate risk by focusing on strong stocks and tailoring my trading strategy to avoid being in situations where I could be holding something and there's a high likelihood of a halt. It's one of the reasons I don't trade the penny stocks, and I don't trade these super risky, the risky type of stocks that you see come and go, pump and dump, if you will. I think that's the best thing to do. Just avoid those type of stocks if you can. So, in the next lesson, we're going to pick up on stock selection, learning how to choose the right stocks. Again, to help us reduce our risk as day traders. As I keep saying, profitable traders, they concentrate on reducing risk. So we're going to look at how we pick the best stocks to reduce our risk as day traders. Okay, so that'll be in the next lesson. And if you've got any questions, just feel to shoot me an email, and I'll be happy to answer any questions. Here's my email address, and here's a few of the tools that I get in, and just look forward to seeing you on the next lesson.